In the final week of January 2026, the global financial landscape witnessed something that felt like a once-in-a-century alignment. For decades, the silver market was the forgotten metal, overshadowed by gold's prestige and Bitcoin's volatility. But as we entered the new year, the narrative shifted. Silver wasn't just a commodity anymore, it had become a symbol of a systemic breaking point. By January 29th, the atmosphere in the precious metals community was nothing short of electric. The price of silver didn't just climb, it accelerated, shredding through psychological resistance levels like they were made of paper. When the ticker finally flashed $120 per ounce, the sense of euphoria was palpable from the trading floors of London to the digital forums of the silver squeeze movement. The data behind this rally seemed ironclad. For months, we had been tracking a slow-motion car crash in the Comex registered inventories. Vault levels were plunging to record lows, hitting what many analysts called Vault Zero, a point where the available physical metal to satisfy futures contracts was effectively non-existent. The narrative was simple. The paper shorts were finally dead. The big bullion banks, which had supposedly suppressed the price for 40 years using unallocated paper contracts, were finally being cornered. Physical premiums were skyrocketing, and the disconnect between the price of a silver eagle and the spot price had narrowed because the spot price itself had finally caught up to reality. It felt like the ultimate "I told you so" moment for sound money advocates. The $120 target wasn't just a number. It was the signal that the fiat system was losing its grip on the one asset it feared most. But, as history teaches us, when the retail investor starts feeling invincible, the trap is already being set. The first crack in the $120 dream didn't come from the silver vaults. It came from the White House. On Friday morning, the geopolitical and financial equilibrium was shattered by a single headline: the nomination of Kevin Warsh as the next chair of the Federal Reserve. In the world of central banking, Warsh is a name that commands immediate respect, and for precious metals investors, immediate fear. Unlike the perceived indecisiveness of previous regimes, Warsh is widely viewed as a hawk, a man who understands the sound money argument, but views it through the lens of a powerful, stable US dollar. The market reaction was instantaneous. This was the Warsh Shock. The nomination sent a clear signal to the world. The era of easy money and dollar debasement was facing a formidable opponent. The US dollar index, or DXY, which had been languishing as silver climbed, suddenly staged its most aggressive one-day rally in years. The Warsh factor flipped the script on interest rate expectations. Almost overnight, the market began pricing in a higher for longer scenario, pushing real yields into territory that made non-yielding assets like silver look suddenly expensive to the institutional algorithms. To the global audience, this was more than just a personnel change at the Fed. It was the weaponization of the US dollar to defend the crumbling bond market. As the dollar rose, it acted like a gravity well, pulling every commodity denominated in it toward the earth. Silver, being the most volatile and leveraged of them all, was the first to fall. But the Warsh Shock was only the catalyst. The real execution, the flush-out, occurred behind the closed doors of the exchanges. This is where the paper manipulation critics find their strongest evidence. As the price began to wobble on the Warsh news, the CME Group stepped in. In a move that many retail traders called changing the rules mid-game, the exchange announced a massive hike in maintenance margins for silver futures. They raised the cost of holding a position by nearly 15%. To the average observer, this sounds like a technicality. In the high-stakes world of leveraged trading, it is a death sentence. Think of it this way. Thousands of traders were long on silver, many of them using 10-to-1 or 20-to-1 leverage, betting that $120 was just a pit stop on the way to $200. When the margin hike was announced, these traders suddenly needed to come up with millions of dollars in extra collateral within minutes. For those who couldn't, the exchange's computers didn't ask questions. They simply liquidated the positions. This triggered what professionals call a liquidation cascade. A sell order from one trader pushed the price down, which triggered the stop loss of another trader, which then forced another margin call, and so on. It was a waterfall effect. The very mechanism that had propelled silver to $120, extreme leverage, was now being used to destroy it. In a matter of hours, $30 of value was wiped off the board. It wasn't just a correction, it was a clinical extraction of retail wealth by the institutional machine. The liquidity grab was so violent that for a brief moment, the bid-ask spreads on major platforms widened to levels not seen since the 2020 crash. The exits were jammed, and the only ones getting through were the big banks who had already positioned themselves for the fall. By Friday's close, the $120 dream wasn't just cracked. It looked like it had been demolished. Technical damage versus structural bull case. As we look at the wreckage of that 30% drop, the market is now split into two warring camps. On one side, we have the bears, who argue that the $120 peak was a generational top, a classic blow-off top, fueled by retail mania that will take years, if not decades, to reclaim. From a technical perspective, the damage is severe. The monthly candle for January 2026 now sports a massive wick at the top, a visual representation of a total rejection of higher prices. But then there is the bull case, and it is arguably stronger than it was before the crash. While the paper price was being decimated on the Comex, the physical reality of silver has not changed. We are still facing a structural deficit that the world has never seen before. The industrial demand for silver is no longer just about jewelry or silverware. It is the literal nervous system of the 21st century. As AI data centers expand globally, the need for silver-coated high-frequency connectors is exploding. The global push for solar energy continues to consume hundreds of millions of ounces annually, and the green energy transition is physically impossible without the most conductive metal on the planet. The disconnect between physical and paper is now wider than ever. While the CME can hike margins to force liquidations of paper contracts, they cannot print more physical silver to fill the empty vaults in London and New York. To the long-term silver bull, this liquidation wasn't a change in trend. It was a gift, a chance to accumulate the most undervalued asset on Earth after the weak hands were forcibly removed from the market. This brings us to the current price action. Following the carnage of Black Friday, Monday and Tuesday have seen silver staging a cautious but persistent rebound. The question on every trading desk is simple. Is this a dead cat bounce or the start of the next leg up? Currently, silver is fighting to reclaim and hold the $90 to $95 range. Technically, all eyes are on the 50-day moving average. If the price can stabilize above this level and consolidate, it suggests that smart money is using this dip to enter the market. These are the sovereign wealth funds and institutional players who don't trade on 20-to-1 leverage and are not bothered by CME margin hikes. We are seeing a massive rotation. While retail was being flushed out, we observed large exchange for physical transactions, suggesting that some major players are taking this opportunity to actually pull metal out of the system at these lower prices. If the support at $85 holds, the structure of the bull market remains intact. However, a failure to hold these levels could see a deeper retracement toward the $70 zone, where the true cost of production for many primary silver miners currently sits. The events of the last few days have proven once again that the precious metals market is not for the faint of heart. It is a battlefield where monetary policy, geopolitical positioning, and industrial necessity collide. The nomination of Kevin Warsh and the subsequent margin hikes were a clear message from the establishment. They will not let the silver shield break without a fight. They have used the power of the US dollar to tame the rally, at least for now. But can a stronger dollar fix a physical shortage? Can a margin hike create more silver out of thin air? Now, I want to hear from you. The global community is watching this chart closer than any other. Do you believe the Fed has successfully tamed silver and that the $120 dream is dead? Or do you see this as the ultimate bear trap before the system finally breaks and silver heads toward $200? Are you buying this dip, or are you waiting for $70? Leave your thoughts in the comments below. This is a global story, and your perspective from your corner of the world matters. As always, remember that the silver market is extremely volatile. This content is for educational and documentary purposes only and does not constitute financial advice. Protect your capital, do your own research, and stay tuned as we track this historic shift in the global monetary order.